Welcome to Upside, where we dig into the real stories that live behind the headlines affecting European venture. Today, it's Lomax, Mads, and myself, and we are talking about the ECB cutting interest rates. We're going to go into a bit of IPO talk. It's a tale of two cities on the IPO front, dig into that. We're also talking about AI copyright and usage and lawyers doing naughty things. And then we're going to tail it off with the UK Strategic Defence Review. Oh, and a little bit of liquid biopsy news from the NHS. Now, to start with, we are going to go straight to the top, and it's the ECB cutting rates. What does this mean for Europe? What does this mean for the UK and in the global context? So to set the scene, the European Central Bank has cut its interest rate for the 8th time in 12 months from 2.25% to 2%, as it warned about continuing pressure on the Eurozone from Trump's tariffs. What does this mean for us, startups investing? Mads, I'm going to kick off with you because I know you know all of the real juice.
Well, it's not only good news, but it's mainly good news. And if you got it, flaunt it and present it in the best way you can, right? So let's do that. Let's put a positive spin on it, at least to begin with. The story here is that the ECB is cutting headline rates from 2.25% to 2%, which is the 8th cut in 12 months. And that's good. Rates are coming down. I think kind of the wider story is that the EU has fiscal headroom and the US does not, because Trump desperately wants rate cuts, but he can't get them. And the reason he can't get them is twofold. One is that EU inflation is now sub 2% and heading in the right direction, and US inflation is at 2.3% and not really heading in the right direction, partly for all the reasons we know. He's got tariffs that are adding costs on imports that are pushing up inflation. But on the top of that, they're also running a terrible fiscal deficit. The US federal deficit is close to 7% of GDP. It's an astronomical figure. It's sort of a wartime figure in what should be peacetime. And the debt of the US is now 50% higher than the EU average. The US at 124% versus EU at 81%. And this means that the EU is just in a better fiscal position. Now, you could say there's a trade-off. The US is growing at 2.6%. The EU is up 1%. Wouldn't it be better to have the growth? And yes, that's back to it's not only good news story, but there's no doubt that you would not want to be at 124% debt to GDP with a near 7% deficit. And on top of that, what they're trying to do now with this quote unquote big, beautiful bill is to add a further lump of stimulus, $2 to $3 trillion further to the debt levels over the next several years. As we've seen, Musk did not like that very much and has left government doors slamming. I don't know whether we're going to come back to that today, but there is a real schism in the US. Are you going to stay clear?
I would love to. I just don't think we can go there. I think my wife was saying to me that it almost feels like comedy. We've almost gone into like the wives of Hollywood or whatever these awful reality TV shows is. I don't even know where to go. Maybe Lomax, you might have some words on this, but Mad, sorry, I interrupted you.
No. It's beyond parody. Yeah.
Yeah. I mean, before we go there, touching a little bit on where I think the opportunity is, because being in a better fiscal position means we have opportunity in Europe, and in particular around investments. Now, I'm not suggesting that we should let rip and just completely abandon all fiscal discipline, but we're seeing around defense where there's a real willingness to invest in our strategic defense capability. We could not have done that as easily, especially powered by Germany, if the European Union's fiscal position had not been as strong. That's one thing. The second thing is we have world-class capabilities in manufacturing, and manufacturing, like AI, is energy dependent. We've got amazing energy technology. Europe is great at things like nuclear. So this is a chance to use some of that fiscal headroom to invest strategically in energy, to bring down the cost of energy. And I think the EU rate cuts show that that headroom is there. So that's really kind of would be my suggestion here, is that we look at that in an aggressive and strategic way.
What about the flow of capital, Mads? This is the one thing you could argue almost from both directions. Obviously, weakening of the euro. Does that mean that we'll see more money going into privates, more riskier assets? Will the yields in the States mean that we'll see more flow of capital back from Europe into the States as interest rates drop? So I don't know quite how to see it in that context as from the flow of capital context.
I think those chains have slightly longer connections, and I think capital is global. So the fact that Europe has lower rates does not mean that European startups will get more funding. It's kind of it's the thing we all want to see, but I just don't think it happens that easily. I think it's much more around providing the opportunity to create the foundation for more successful industry and tech sectors, and that is what will attract the funding.
And then we just have the pure sentiment here, which is, do you really want to be investing in the States right now with such volatility and with such a volatile leader?
Correct. The counterpoint is Europe has sub 1% GDP growth. Do you want to invest in a low growth environment?
And the UK even less, right? And the UK was downgraded even further last week. So there's so many opposing forces.
US is pumping at the moment. And so what I understand the volatility point, Dan, but where do you want to invest? I don't know. I think the US still has a pretty compelling proposition there. But I think, Mads, just to pick up on what you're saying, I think you're very optimistic in what you say, which is good. I think
It's my job,
there
isn't
are,
it?
of course, yeah,
That's
there
our
are.
job.
Well, I think we're supposed to be optimists and pessimists at the same time, but yeah, exactly. I think certainly optimists generally. They're both long-term indirect consequences of what you just described, the rate cutting. I do actually think if you move back to a sustained period of low interest rates, then there is a rotation into riskier assets and there is funding available for startups. But if you think about it, basically interest rates for a sustained period, decade plus, were almost below zero, and then went up to, in Europe, went up to 4%, now back down to 2%. So for that, if we're seeing a sort of secular change or a shift back to a decade of very low interest rates, then I think on a 5 to 10 year lens, it bodes well for riskier assets, which includes startups. I think on the investment into the critical things that you talk about, yeah, I mean, it's absolutely needed. We're going to, I think, talk about data centers a little bit today, and the energy costs are an absolute abomination in Europe, and they need investment, and it's great. All of this just takes a very, very long time. But the governments, with Germany's big infrastructure spending bill, and UK has got its spending review coming out this week, that all those kind of investments are going to be necessary for upgrading the infrastructure, which will also unlock potentially AI, significantly AI going forward.
The US, okay, it's volatile. There's a whole bunch of stuff going on across private and public markets. But just looking at the IPO piece of the picture, I mean, looking at the States versus the UK, it is absolutely two different stories. So US activity is about 80% up on 2024 figures, and UK is nearly the same percentage, but in the wrong direction, with loads of green shoots happening in Europe. And here's a quick fun fact for you. 3 of the biggest IPOs of last year were in Europe. So that was Puig, the fashion and beauty brand on the Spanish exchange, Galderma, the dermatology company on the Swiss exchange, and CVC Cap, the PE firm who listed in Amsterdam. But Lomax, tell us more what's happening in IPO land. It really is kind of massive, massive stuff over there, naffle over here. And then let's bring it back to how this affects our ecosystem, how this affects startups and investing.
Well, I think there's big headline grabbing numbers in the US, and lots of walls of money moving, both being raised and being made for equity investors, and pretty slim pickings in Europe. I mean, looking at some of the numbers. So if you take the US has done 143 IPOs this year. Like you take the UK, for example, has done 5. And then one number that was really shocking to me is in the IPOs in the London market this year, only 75 million, total 75 million has been raised in fresh capital, whereas that number is about 13 billion in the US. It's quite depressing. I think this year there have been, I think, no venture-backed IPOs in London. In the US, there's been 9, so significant ones we've seen. Hinge Health, CoreWeave, Armada, Circle Internet. They had the choppier times earlier this year with Klarna and StubHub postponing their IPOs, but it seems to be back now. CoreWeave, one of Mads's favorite companies, has soared since IPO, is up 3 times now, listed at $40, now 150.
It took a recent dip there, didn't it, Lomax? Didn't
A
it
small
go
recent dip, but I mean, come on.
gangbusters?
Yeah. It's up, over 3x from IPO. Armada was up significantly, up 50% on its first day. Armada Health just IPO'd, another venture-backed tech company. So I think, the story on the IPO scene is definitely very, very, very different. I think then couple that to some recent news where 2 UK listed companies have announced, big changes in their listing. So Wise, which is, the challenger bank, has just announced that it's moving its primary listing to the US. And Indivior, which is a pharma company, it was already primarily listed in the US, but it's cancelling its secondary listing in the UK, right? So those two kind of big hits to the UK stock market. And I think why does this happen? Well, there's just much more money in the US, so it's easier to raise money. There's significantly more analyst coverage. I think one thing you can do, just as a reminder, is you can list in Europe or list in the UK, and you can still tap the US markets, right? So you can still have these things called American depository receipts if you're a European or UK company, but they are less liquid, less easy to raise money, as they don't have the analyst coverage and don't enable you to get into the relevant indices, S&P 500, etc. So it is very much a kind of secondary access to that capital market. And let's just step back. US public capital markets, I think, is 50 trillion, and the UK is 3 trillion. So sometimes we think in venture that we talk about UK to US disparate, the difference is the US is 17 times bigger when it comes to the size of the capital market. And there's a really astonishing one, which is liquidity. US turnover per day is 500 billion of stock, 500 billion per day. In the UK, it's about 8 to 10 billion per day. It's 50 times different. It's astonishing. So I think if you're wise and you're looking to raise more money, raise your profile in the US, if you've got to go to market there as well, I think this is a bit of a no-brainer. It's just walking into a wall of money and exposure and profile, etc. I think the Indivior thing is a little bit secondary. They have most of their shareholders are in the US, most of their businesses in the US. All they're doing is cancelling their secondary relisting in the UK. Why is this relevant for tech and startups, guys? Because I think everything that happens in the public markets flows back to what we do. Ultimately, we are investing in early stage startups. Where are they going? They are going to the public markets, and or private markets are valued by reference often to what's going on in the public markets. So it's incredibly important, both in terms of what's happening, the valuations there, that all flows back to what we do. And I'll just say one final point. In the UK, technology is 1% of the FTSE 100. In the US, technology is 30% of S&P. So when you think about it at the relevance of us and where our founders might want to go to IPO in the same light as Spotify, UiPath, Auto One out of Europe, the difference is I think when we talk about US EU difference a lot, it's this public capital markets piece that is staggering. I think about the difference. The good news is, as Mad said, capital is global. It's friction, certainly not frictionless, but it's boundless. So you can take your European company, you can build hundreds of millions of revenue here, and there's a market for it in the US. So I think it's depressing that these companies aren't IPOing here, but it's not the end of the world.
I want to have a very quick sidebar conversation around Pisces. Not really on topic, but it just came to mind as you were speaking, Lomax. Now, Pisces, I can't remember what the acronym stands for, but it's a way effectively of getting stock options, and I guess it'll be Series B, C startups, so later stage startups, to get more liquidity for founders and for stock options holders. So getting private markets, some version of a public market trading facility. But do either of you know any more about it? Will it be relevant at all? Will it work? I don't know if anyone knows anything on the Pisces topic. I think it's coming, it's June. I think it's coming live in June.
Really, what Pisces and other schemes like it are trying to address is the symptom of a stock market where it is difficult to go public and companies stay private for longer, but we still want to have liquidity and give people access to trade these underlying companies. And so we create these quasi-public markets or liquid markets, or try to do that in private companies. And it just seems to me to be absolutely the wrong remedy and prescription for the symptom, because public markets have their strength and private markets have their strength. And private markets are all about inside information, knowing the company closely, and being able to make quick decisions based on working closely with management teams and having that very intimate knowledge. That obviously does not work in a public market. You have insider trading laws, and people need to be able to trade on the basis of an equal access to information. And so the response to the public markets not working can't be to try and make public markets out of private markets. It's bound to fail. It cannot work.
Well, you can't raise fresh liquidity. I mean, you can't raise new capital using the Pisces scheme, can you? So
no, but you can still trade. It doesn't. You talked about this before, and we talked about Carter, for example, trying to do this, like trying to create some little sister or little brother of what is a very well established, highly regulated, centuries old system. I'm sorry, like I'm all for like optimism and new things and whatever. I don't think it works. And then well,
No,
Carter pulled out of it.
It's just a fundamental misunderstanding of how the markets are meant to work. Right? I mean, you cannot have a situation. The people that sell, by definition, are insiders. They're holding something. They're closer to it, and the buyers are outsiders. It's totally the wrong remedy.
I didn't want to distract us from the core topic. I knew it was always going to be a bit of a sidebar.
Yeah, I mean, so let's look back around the real story here, which is London's systematic failure as a public market. Endless delistings, very, very few new listings. We talk about how much bigger the public stock markets are in the US than in the UK. And Lomax, you shared some great stats there. But one stat that is staggering is that when you think about the US market as 16 to 17 times the size of the UK market today. But that's a new phenomenon. If you go back 15 years or go back to 2007 before the great financial crisis, the S&P 500 was only about 3 times the size of the London Stock Exchange. So there's been a dramatic hollowing out of London's position as a financial center, especially on the equity side. Part of that is due to the weakening of sterling is down about 40% over the period, but it just doesn't explain the whole difference. And so there are all these things, Lomax, you mentioned about kind of liquidity crisis. You have much less daily turnover in the UK. You have a regulatory burden, which makes it hard to list. If you go back 15 years, London was the go-to hub for fintech companies. And in so many ways, Circle is an example of a company that could have been and should have been built here, but was built in the US instead. And Wise of a company that was built here and is here, but now is moving the listing to the US. So there are missed opportunities all around. And just double clicking on what's happening here with crypto and stablecoins. So stablecoins are really becoming part of the global financial infrastructure. And we've seen with the new US Genius Act that's going through committee currently and kind of the role stablecoins are taking. Today, Stripe is offering stablecoin accounts across more than 100 countries. So this is not about crypto Ponzi, lala. This is about using stablecoins as an alternative to traditional FX rails like Swift. So it's incredible. And stablecoins have got a huge volume. I think the volume now is as much as Visa is processing on an annual basis globally. So it's become a real thing, and we should have that here, but we've been fiddling, and the US is capturing some of that. So we can go on to what can be done. I think it's clear that we need to strengthen the financial markets. I think so much of that, of course, is regulatory, multiple share classes, dual share classes for founder control, simplifying regulatory issues. But we also have to talk about money. And the truth is, 25 years ago, UK pension funds had 50% of their assets in UK equities. And today it's less than 5%. And some of that, people are saying, is driven by lack of tech companies in the UK. And yeah, that's fair. We need more. And some of that is driven by the fact that you have the global tech leaders and they're in the US and they're driving indices. And if you want to follow index performance, you have to be in these behemoth companies. And so capital shifts to the US. And that's fine. I'm not proposing that we should stop that. We're sitting in a death spiral here. When you go from 50% to 5%, that is beyond alarm bells. That's like, this is near terminal. And I think, it's an excellent example of why we need pension reform. Now, I think this should cover both public and private markets. On the private market side, we've talked about how difficult it is for pension funds in Europe to invest in venture capital and private assets. And there is a long list of reasons, kind of their fee caps, there are some of the fiduciary rules around what trustees needs to do and kind of not giving them a safe harbor provision that could protect them. And there's also scale fragmentation with too many small schemes. All of that can be addressed. But I think coming back to the public markets discussion, I think there's a wider point here, which is that today, the UK gives very, very generous tax incentives for pension savings. So it costs more than £50 billion a year. It's equivalent to almost 5%, 4.5% of all public spending is the equivalent of the tax incentives that go to pension savings.
It's the same as the defense budget, basically, yeah.
Right? And so I don't think it's unreasonable to say that in exchange for these very generous tax breaks, that some of the funds have to be put to use to invest in productive assets in the UK, both in public and private. And so I think there's a huge opportunity here. I mean, it's going to take some political will. And I do think the government has sight of some of this. But again, we just need to move a little bit more decisively. We're into overtime here, and it feels like we're taking our sweet time working this
But you know
through.
what, Mads? Sorry, just to jump in. From memory, there's roughly, I think, 3 trillion of assets combined in UK pension, right? I think across the defined benefit and defined contribution schemes. So even if you increase the allocation of those, that 3 trillion assets, you enforce a rotation out of the US into the UK, still not really moving the needle massively, right? I guess, in the context of, London, which we just said has roughly 3 trillion of market cap total, right? So you could potentially move that significantly. But in the context of the US's 50 trillion of market cap, you're not even like, you're not really bridging the gap in any meaningful way at all, right?
There are two things that add there. There is market cap, which is kind of the value of the total market, and then there's money that's put into a market. I think part of the argument I would make here is that the value of a company is often determined on the marginal supply and demand, not the total supply and demand. So we don't have to put £3 billion more into UK equities to increase the value of UK equities by £3 billion.
Uh-huh.
Okay, just by having more marginal demand, you can increase the multiples,
Sure.
and that will increase the total value. I think that's one point. The second point is we need more capital across not just publics, but the full stack. So we create more IPO candidates. And that's especially around growth. It's kind of the pre-IPO phase. Whereas if all the great tech companies go to the UK to raise their growth round, they're also going to list in the UK. And if we can put more capital to use in the later venture phases here, I definitely think that will help the IPO funnel.
It's all about more money.
It's all about the money.
More money, baby. Show me the money. Show me the money. I want to change tack. I want to just dip into a couple of AI stories that have cropped up this week. So one being the creative industries have, according to Baroness Biban Kidron of Bridget Jones fame, she was the director of one of the Bridget Jones movies. So she's in the Lords, and she has basically said that the creative industries are being shafted by the UK government. So the UK government is trying to pass a bill that will allow AI companies to use copyright material with an opt-out, and the Lords has rejected this proposal for the 4th time. And the second story that I wanted to dig into, and I'll tell you why in a second, was that lawyers are now facing sanctions if they cite cases after using ChatGPT that don't actually exist. There have been a number of high-profile cases of lawyers using cases that don't exist in the real world. So AI is now obviously butting heads in the real world, and there'll be much more to come. What sector is next? Who will the winners and losers be? There are so many questions around this, kind of where AI meets the real world. Lomax, do you want to kick this one off?
Yeah, look, to be honest, I don't have a strong opinion where this is going to go. Like, there's this new data use and access bill that's been batted back and forth between the House of Commons and the House of Lords in the UK. I think the Lords have sent it back 3 times. The Commons can push it through anyway, so it's largely academic, quite frankly. I think the major sticking point now is it's not the concept of the AI companies being able to use copyrighted material, but it's around disclosure. I think the Lords really wants to force the AI companies to actually disclose where they've used copyrighted material. I don't have a strong opinion where that ends up. Like,
Hasn't the horse already bolted? Hasn't the internet already been absorbed?
Yeah, okay. I wouldn't necessarily take. I mean, look, I think if there was, look, I mean, this is a big industry. Take the UK, but it will apply across other economies too. This is roughly the creative industries contribute roughly, or the size of them is roughly, I think, 135 billion pounds in the UK. So these are not insignificant parts of the economy. And I think just to not protect them and let them go up in flames is clearly, which by the way is not going to happen. I think that's hyperbole. Is there a way in which compensation can be managed? I think it would need to be a commercial thing rather than a regulatory thing. I don't know, Mads, if you have a strong view here, but I don't know where this ends up, quite frankly. Like in the US, it's a little bit more permissive. They have this concept of fair use when you're using copyrighted material. And as always, as you would expect in the UK and the EU, it's more restrictive. But I don't have a strong opinion here, quite frankly. I don't think the government should be mandating payments. I wonder where I would love it if there was a way for the creators to make money out of this. And to be honest, the commercially savvy ones will probably find a way to do that.
Mads, where would you
Yeah, I
take
think
this? I mean, the tension, right? The tension is between the freedoms around AI and the economic boon therein, and protecting copyright holders. That's the tense piece. But Mads, where would you take this?
yeah, going one step further in the context of what we've just talked about, creating more great technology companies in Europe and in the UK, if you have kind of competitors where in China you have, should we say, they're very relaxed interpretation of Western IP protection laws. And in the US, actually, people talk a lot about the US fair use, but there are a lot of lawsuits now underway. An environment where you have a lot more capital. And so the large AI companies can count on A, massive war chests, and B, almost infinite investor backing.
Isn't Reddit suing Anthropic? Who's suing Anthropic?
Indeed. Yes, Reddit is. And so, but Anthropic can go into this knowing that they can raise probably as many billions as they need at the end of the day. So it will be litigated in the US and a solution will be found. And that's
well, and
just
also,
a
by the
really
way,
hard
Reddit and their
path.
lawyers will know. Reddit and their lawyers will know that, right? So in a way, it's all just part of the kind of US, like the commercial, very very commercial way they approach litigation in that jurisdiction.
There is that, but we also need to think about it from the perspective of investors, because our investors going to fund that business model in Europe, knowing that there's much less capital available. And so there is a real tension there. I think the question is, how do you find a middle ground? Of course, we want to protect these wonderful creatives that have given us so many cultural treasures over the years. And at the same time, we don't want to fall behind on AI. And I think, what are some of the things that can be done? I mean, you can look at opt-outs rather than opt-ins, so saying that, yes, there is a general blanket permission to train unless people have specifically opted out. You can provide safe harbor provisions for open source technologies or for smaller projects to make sure that if you are sub 25 or 50 million in revenue, basically you have a safe harbor circle around you, you can't be sued. I think there are a lot of things that can be done to stimulate the environment, but it's clear there's a tension. I think we can't shy away from that.
I always wonder if there'll be a commercial model around working out which model has absorbed which copyright material and then working out some kind of Spotify-esque apportionment. But I don't know. I mean, on a practical level, if a song is created by AI and it's inspired by Stevie Wonder and George Michael and Michael Jackson, I don't know how you would work out how many beats in the bar are apportioned, or how many pixels in the picture are apportioned. I don't know. It's just such a quagmire. I would not like to be on any sides of this coin. Changing tack even further, we're bouncing around a lot today, but we've had the UK Strategic Defence Review out. So this is a NATO-first plan to bring the UK up to speed to protect itself and other NATO countries, spending around 87 billion over the next 10 years. How much is to be spent on what? Where? Are there opportunities for startups, investors, or not? Interestingly, the government may force/encourage the use of UK vendors. Currently looks like there's about 60% of the existing spend will be spent in the UK by the UK, which is great to see. But with 80% plus spent on physical things, including kinetics, boats, submarines, and around $1 billion to be spent on digital and cyber. Is that the right proportion? Can we even afford any of this? Lomax, give us some more of the juice on what's happening with the UK strategic defensive spend.
I think this is the latest strategic defense review by the UK. It's the first one since the Russian invasion of Ukraine, at least the 2022 version, not the 2014 version. I think it's no doubt a good thing that the UK, well, given the geopolitical environment at the moment, it's not surprising that the UK is now increasing defense spending. I mean, the numbers are still relatively small, actually. Like we're talking about increasing defense spending, so from 2.3 to 2.5% of GDP with a longer term goal of 3%. I mean, that does put it above the 2% NATO target, still below the likes of, at least in percentage terms, Poland, Estonia, and Latvia, which are 4%, but it's still, in absolute terms, the sixth biggest defense budget in the world. Still significantly smaller than the US, which is close to $8 trillion. And this spending review will take us to roughly $100 billion, so 70 billion pounds. Definitely an improvement on the last spending review, which was in 2021 before the Russian invasion of Ukraine. I think people have now focus more rightly on technology in the future. And before we used to focus on like big, what we would probably call white elephants now, like big, aircraft carrier investments and, showboat type things like that, but not have the money to do it properly. So you would, for example, spend 6 billion on 2 aircraft carriers, but you wouldn't have the number of F-35s to even make those operational. I think the focus has gone away from vanity projects like that now to more AI, cyber, autonomous systems,
My
etc.
personal
So I
take is
think
it's not enough.
no, but as we also talked about before, a lot of this amount goes on very boring logistical infrastructural stuff. It goes
Yeah,
on
1.5
troops, it
billion
goes on
into
barracks.
upgrading barracks and
Of
the
course, but
places where
that's,
the
I mean, that
squaddies sleep.
it's also, yeah. But it's the same when you talk about the 200 billion health budget. Like actually a relatively small amount goes on technology. Most of it goes on, people and infrastructure, etc. I think Mads pointed out last time that the Germans have, failed to find the details of their reservists. So all the money goes into like figuring out these problems of identifying people and calling up people and coming up with recruitment programs. I mean, logistics is an absolutely critical part of defense, obviously. So you can't not invest in that. So if let's take it back to startups, there is a 400 million, which seems very small, defense innovation fund that they've announced. That I think is an annual amount. They want to actually start getting that out the door from May to July onwards, so actually being relatively quick. So yes, it's a relatively small amount. It's something that will trickle through to startups. Of course, the existing defense primes and contractors have a massive head start in that they already have the procurement systems in place. So I think this kind of slightly gilt-edged, optimistic view that lots of defense startups are going to be running around with big shiny contracts might be a little bit optimistic, but there certainly is opportunities for them. I think they are going to need to learn some smarts on the procurement and distribution side, and that will take probably longer than you would hope. The backdrop here is still lots more money going into this is a week in which Anduril has just announced a 2.5 billion fundraise at a 31 billion valuation founders fund, put 1 billion into that round, right? So there's still lots and lots of money going into this. Interestingly, in that strategic defense report of the UK last week, they referred to a new prime. That's the language they use. So there is an acknowledgement that both the future does envisage not just the classic, BAE Systems, Lockheed Martin, etc., winning all of the contracts. So I think this is a good thing. We've seen, and we talked about it last week, the SAFE, not the SAFE investment instrument, but the security action for Europe, which is a 150 billion initiative in Europe, in the EU, which is has similar goals. So this is all part of upskilling, uptooling, and there will be pickings, hopefully more than pickings, interesting things for technology startups working on drones, automation, AI, cyber. And we're seeing, if you just look at the news, just picking out, recent rounds, for example, there's a company called Labris that just raised a 20 million Series A in the UK, led by Plural and Albion. Company called Lendure AI in Estonia that just raised 6 million seed to focus on autonomy stacks for drones to enable them to operate in GPS denied environments. So when you look at what we do on our daily basis, and you guys are obviously a SaaS fund, I'm a little bit more deep tech in my investments. But if you look at the kind of investments that we've been looking at over the last 5 to 6 years, now you're seeing more and more defense companies woven into the pipeline and deal flow and what founders are building. So I think that's fascinating. And they're not all guns companies. Labris is a workforce management company. So in defense, so it is a lot will be focused on that kind of logistical piece. So big picture, all good. Lots to be done long term. These are kind of targets that will take time to hit, and money trickling through to seed stage startups just takes time, especially in a government procurement process.
My personal take is that this is going to lift Europe. This spend and this focus will lift Europe financially. I think it'll have some serious inroads. But Mads, do you agree, or where would you take this topic?
Thought going through my head, you're positive, and the defense review is kind of, spending on UK defense innovation. There's this new 400 million pound ring fence fund targeting startups, and it sounds like a wonderful thing. And then you put it in the context of, as you've just said, Lomax and Durrell raising $2.5 billion, which is 6 times the entire innovation budget of the UK in this defense review. Are we wasting our time here?
Okay, one thing I will say, Matt, sorry, is that you're not wrong. When we just spent the beginning of this pod talking about the difference, sheer difference in quantum in amounts across many things when comparing UK Europe to the US. But actually, defense is interesting because it's an area where even well-funded companies like Anduril may struggle to get traction given the move towards defensive sovereignty. So actually, in a way, the UK and the European startups for once actually have a bit of a head start, or at least have a major competitive threat removed. I mean, if you look at Palantir, that is just on the data side, that is, won hundreds, certainly tens, if not hundreds, and billions of government contracts in Europe for what it does. I don't think Anduril might struggle to do the same in the in defense. And so actually there is scope for the Helsings of this world, that would, being the sort of equivalent of Anduril in Europe, that, these are not insignificant amounts of money. If you want an IPO company these days, you need to be generating 250 to 300 million of revenue. There are businesses that can be built of this size with these budgets, I'm sure, in the UK and Europe. And they don't have the US competitive threat.
Another vector, another angle. Well, let's accept everything you've said. The US is not the main competitive threat here, is it? I mean, the main competitive threat is China. And even if you feel that China invading Europe is a bit far-fetched, which it probably is, we know that they have a close collaboration with the Russians. The Russians want to export oil and minerals, and in return, they'd like to buy Chinese technology and arms. Are we wasting our time? You look at the amount of funding that's going into this sector in China. Is this going to make any difference?
I don't think wasting our time, because you have to spend the money here. You have to have sovereign capability. It's like, I think we've learned, in the last year, if we didn't already know, that
I'm
this is not
talking
stuff
about the
that you can buy.
scale. I'm talking about 400 million in what seems to be a global arms race with much, much bigger numbers. I'm talking about the whole context of a standalone UK defense review. And a part of me is always almost sort of saying, why are we even bothering? Is there any way to make a meaningful difference here? You bring up Helsing. That is probably one of the few really meaningful things happening in Europe right now. And it's not a UK company.
Yeah. So certainly there needs to be, I think UK and EU need to work together on this. We talked about, I mean, UK is now trying to get into this whole safe concept that I just talked about, the security action for Europe. So I think that probably needs to be a pooled resource. By the way, sorry, the 400 million is the Defense Innovation Fund. There is billions going into, cyber, drones, autonomous systems on top of that, right? So I think like there is 400 million of the 67 billion budget is not just going to technology. It is a bigger proportion of that, but still, I know what you mean. I certainly know what you mean.
I want to just lean into an adjacent topic around AI infrastructure, because I think there is a segue here, and I want to talk about this before we go. So AI infrastructure in Europe, we've talked about this a lot. I know Andrew, who's not with us today, this would be music in his ears. There is a consortium coming together to bid for one of these first new EU-sponsored AI superfactories in Europe. So I want to quickly delve into this and see if there is a connective line between defense and kind of this kind of economic growth piece. And can Europe do AI infrastructure? So Mads, can you lead us on this one?
We can talk about what's happening around these EU AI superfactories, where we have seen a target of investing 20 billion into creating large-scale AI capability. And we compare that to the US Project Stargate, which is 100 to 500 billion in scope, 100 billion to start off with. So the first obvious observation is there's just a scale difference here once again. But I would say we are starting to see some real things happening on the ground. We've got one of the first consortia coming together. Deutsche Telekom is working together with SAP and others to get the first data center off the ground. So kind of first 100,000 GPU supercluster in Germany. It's a good thing. So there's signs that something is happening. But gosh, we need so much more, so much faster.
Lomax, where would you take this one? Can Europe do AI infrastructure?
It can do, yeah, for sure. And it will take time and capital, and the energy costs are a major stumbling block here. So especially if you project that the power taken up or power usage of data centers is going to grow from low single-digit % to potentially up to a third of drawing the electricity installed base in Europe and the US, for example, you got to get those costs down. So this goes into the nuclear, like long-term, preferably clean power that is delivered at affordable prices. I think depending on what stats you take, commercial energy in the US is anywhere from 2 to 4 times cheaper than the UK and Europe. The number of data centers in the US, I think, is 5,000. In Europe, it's a lot smaller, right? But interestingly, the capacity in the US roughly twice what we have in Europe as at the moment. However, the pipeline in the US is staggering. So that's where Europe is being left behind. So I think what what we talked about here is important because it's sort of, playing part of European catching up. And I'll just give you one anecdote chatting to someone, looking to build a big data center outside London. He, at the last check, couldn't get his grid connection until 2035. I'm not saying we need to rip up all planning laws. I'm just saying for critical national infrastructure, you need to have a fast track process. Very simple.
Well, I guess we'll put this in the wait and see, watch and hope bucket, but hopefully we can see much more sovereign control, much more AI infrastructure in Europe, and it looks like at least there's something happening, which is great.
Can I talk about liquid biopsies very quickly? We don't need to do a whole piece on this.
Yeah, no, let's do it, because I know this is a topic close to your heart. So there's been a NICE or an NHS breakthrough this week, hasn't there?
I think this is interesting because we've talked about before, like using technology. In the past, it's been about using AI to bring down government costs. So in this case, the NHS is the first government system to roll out a new technology, liquid biopsy, to a certain subset of cancer patients in breast cancer and lung cancer. I think it's fascinating because it's an example of a few things at play that get banded around a lot that I think are actually seeing now in real life. So this is an example of precision medicine, which is something that a lot of people talk about, but I think it's good to see it in the real world. And it's an example of the NHS being very forward thinking and using a new technology to actually drive better outcomes and reduce costs, which is your holy
Just explain,
grail, right?
Lomax, just explain for those that don't know what liquid biopsy
So
means.
liquid biopsy is a blood test that can identify fragments of DNA in the blood called circulating tumor DNA. It's as always with these technologies, started out in a lab, ended up being brought out of the lab into the kind of real world setting, largely from Silicon Valley and actually Boston and venture-backed funding. So in the last 20 years, it's a good example of venture capital doing something that is very meaningful and impactful. Why is this relevant? So it's a very versatile, flexible technology that can be used in the context of cancer, for example, which is the main kind of use case, as it were. First, it can be used to detect cancer in healthy patients like you two and me, hopefully. So it can be used as a screening device. That is not what it's being used for here, and that is much sort of longer term. But that could be in the same way that people have been doing MRI scans. We've talked about NECO and ESRA, et cetera, before. You can actually do a simple blood test to look for circulating DNA of tumors in your blood to give you an early warning signal as to whether you actually have cancer. In this case, it's another use case, which is where you can use the liquid biopsy, so the blood test, to actually understand more about the tumor. And then once you know more about the tumor, you can then drive specific treatments to it. So traditionally, normally, to biopsy a tumor, you need to go into the body and take it out. That means an operation, general anesthetic, surgery, etc. This can now be done with a simple blood draw from a nurse. So that's fascinating. So you can then drive the specific treatments to it. You can at the same time monitor by looking at the tumor DNA activity in the blood. You can look at whether the response to the treatment is going well or badly. So I think that's a really interesting, and that's what it's being used for here. You can also then use it, which is the way that I'm using it in my own treatment, is to once you're in recurrence, whether it's coming back. Yeah. So you keep doing blood draws to see whether actually the numbers spike up. Now, why is this interesting in the NHS, right? So this is actually only going to save in the context of lung cancer £11 million a year. So, we talk about the NHS budget being 200 billion, whatever, 220 billion. So in a way, you could be like, well, so frigging what? Like, but at the same time, that's just lung cancer. So if you roll that out across all solid tumors are roughly 80 to 85% of cancers. You roll that out across all cancer, you probably got savings of 250 to 500 million a year. So this is just an example of one technology being used to drive better patient outcomes, reduce costs potentially at the, say, 500 million mark. I think this is fascinating. The NHS is the first government to adopt this, and this is great news.
Love seeing your face, like, because this is technology, venture-backed tech, coming good, solving in the UK, and helping real-world people do better things. That's what a wonderful thing.
I mean, the only thing I would say is all of the investment, the billions that have gone into this, Sequoia have backed companies, and they're all listed now, Guardant, Natera, et cetera, are all in the US. However, there are some very interesting startups in Europe now that are taking this technology and applying it not just to cancer. You can use it to check whether transplants will be accepted. You can use it potentially for Alzheimer's. There's a whole new kind of potential use case for this technology. So I'm optimistic for the future on it.
Lovely. Mads, anything you'd like to add here?
Yeah, I think it's, as you say, it's a wonderful story. Providing some of the context around what's happening in healthcare in the UK is that we are in a pretty dire situation. We've got spending increased by 14% since 2019, but outcomes are nearly 7% down in terms of productivity, in terms of what we're getting for the money. And so we need technology like this to improve productivity, and we have technology. And that's the great news. And I think there is a real political will to try and, implement it. As I saw that there was 180 million pounds put aside across 6 categories to put AI diagnostics, already this year. So, we're moving in the right direction. But what I'm still missing is some courage around saying what this will mean. If you look over the horizon of this parliament, the next parliament, and the budgets and the fiscal outlooks, when can we start to take resource that right now is going into not delivering very much and moving that to more productive areas? And what I worry is that what will happen is what often happens in public services is that we just keep spending and spending and spending more year after year instead of actually saying, gosh, we can do so much more now with less money. Doesn't that then mean we can free up some resource to put to some of all these other things we talked about around defense, around energy, around AI in general? That's what I would love to say.
Yeah, what you don't want is to say the 500 million of savings that this could potentially save across all of oncology to be just like absorbed by some random thing elsewhere in the NHS. Exactly. Yeah.
Gents, before we scooch off, anyone got any deals of the week? Lomax, got anything on your docket?
2 deals of the week. So Mubi, which is a 2007 initiated startup in effectively streaming, but they've also moved into production. So maybe you could kind of call it a sort of London-based Netflix. Has just raised out of nowhere 100 million from Sequoia. So good for them. Building a big company takes a long time, and 10 million of ARR in 10 minutes, which seems to be the sort of vogue these days. There are other ways to do it, so good for them. And I think actually, just talking about health, so psychedelics is a big merger that was announced this week in psychedelics, where actually Europe does have some of the biggest players in the world, so it does actually have a kind of prominent position. Psychedelics being relevant because they are trying to come up with better treatments for mental health, which is one of the biggest components of these health budgets that we just talked about, right? So Atai Life Sciences has announced its effectively acquisition or merger with Beckley Psytech. Why is that interesting? It's consolidation in the industry. It's an exit event for Atai is a listed company. So it's an exit event for Beckley, which is now waiting the readout of a phase 2 clinical trial applying a naturally occurring substance called DMT run on a clinical trial for treatment-resistant depression, so TRD. So if there's a positive readout, that will be great for everyone. And psychedelics now is awaiting 2 to 3 very, very important big clinical trials. So you probably read about lots of money going into this very hot area. It's now kind of got to the next plateau, and then we will see now the effects or the conclusions of those clinical trials, and then you will see whether the FDA and the MA in Europe will actually approve these things. And it looks like with, Kennedy and Trump in the White House, they are actually sympathetic towards this. So let's see.
Mads, any deals of the week from you, my man?
We occasionally talk about European founders and startups going to the US to raise capital. So there's a story here, which is maybe both a bit of that, but maybe also sort of slight silver lining and something else, which is Grammarly raising $1 billion. And it's a Ukrainian-born company, and they raised $1 billion in a round led by General Catalyst. So wonderful to see some amazing tech coming out of Ukraine of all places. And as far as I understand, they still have a fair deal of devs and techs, sitting over there in the context of all the terrible things that are going on in that country. So I think there's, some positivity here, although I would have loved to see that round being underwritten by a London-based firm and not a US firm.
Well, that was a non-dilutive financing, right? So that was 1 billion financing, and they're going to take, I think, rev share off the top of what they're going to use the 1 billion for with the new products and services, etc., that they build. They'll be taking a rev share off that to pay, obviously, with interest and coupon on the 1 billion. So it's an example of GC, one of the big behemoths of these venture funds, innovating on the sort of financial models that they offer to startups and also offer to their LPs in
I
terms
so
of the
want to talk
return
about new
profile. So
VC funding models at some point.
this is Mads' least favorite topic, but I think
I
it's,
know. I so want to go there. I so want to go there. I'm going to keep nagging and nagging.
so I mean, just think about it though. If you're the founder of Grammarly, you've just raised 1 billion in non-dilutive funding. I mean, that's pretty damn good, no?
Yeah, I'd
Phenomenal.
take that every day of the week. Gents, it is a pleasure and a gift as always talking to you. I'll catch you next week.